Hi there, welcome to Kneppy Invest. Let's talk Step One clothing. This company sells underwear. I have actually ordered some underwear from this company. And in fact, I'll talk about this order later in the video because there is a possibility, just a possibility at this stage, that Step One had a really good Black Friday, Cyber Monday. And the reason I say that is I did my order around Black Friday, and I received it expecting the delivery to be made within 1 to 3 business days. The delivery has yet to arrive, but thankfully the company has been in communication with me, and in one of their messages, they did say that the activity on those or that weekend, starting Black Friday, was significantly higher than they expected, and actually had to hire more staff. So this was either a good sign about how this company is performing or performed during that very important period, or it could be just the management or the marketing team, sales team making some excuses about why the order was taking so long. And who knows? I don't know. So hopefully we'll see a trading update from the company saying, yeah, things are moving really well for Step One. Now, one of the reasons I decided to buy some underwear from this company was just to try the product. And the main reason I want to try the product is I heard they are bamboo, and I love bamboo underwear. And some other people I've talked to have said that when you buy a pair of Step One underwear, you don't go to anything else because they are comfortable, and this is really convenient because Step One will just send the underwear to you. Probably the only problem with Step One is the prices. Now, fortunately, because of the Black Friday sales, I was able to buy quite a few pairs at 40% off. Now, one of the other reasons I want to discuss Step One is because I am trading this company right now. And the question I have for myself is whether this company belongs in my small cap portfolio or whether I just should trade it. Now, the share price has gone down a fair bit over the past few weeks. In fact, I'd probably say right now there is a little bit of panic selling. Share price down 8% as I speak on the 5th of December. Not massive volume coming in, but this is a sign when the share price decreases like this, it's just panic selling. People have seen the share price drop, and for instance, it dropped 8% yesterday on the 4th. It dropped 4.5% on the Friday. In fact, the share price got to a high of about 89 cents not that long ago, and now it's 63 cents. And during that time period, from 89 cents to 63 cents, the company has not released any information yet. They have indirectly implied to me that they had a really good Black Friday to Cyber Monday period. Now, I want to figure out whether this is a potential longer term hold. And the reason I'm questioning this possible decision or soon to be decision is when I looked at the financial year results, I was surprised by one thing. And that one thing was gross margins. This company's gross margins really intrigues me. So let's have a look at their Appendix 4E. I think this might be the annual report as well. So first problem I do have with Step One is revenue down 9.7% from last year. Now, I do like companies who have increasing revenues. Now, this could be just a one-off, and possibly this could be just an effect that they really benefited from COVID-19. People bought a lot of underwear, and now they've pared back their spending of underwear. And maybe as we move into financial year 24 or calendar year 24 and beyond, people will start buying more and more underwear. Now, one of the effects of decrease in revenue is because this company has really good gross margins, and I'll talk about that in a second. I've already given away what surprised me about this company. Because they have really good gross margins, they decrease their advertising and marketing. And that's a really good thing about a company having really good gross margins is they can spend a lot more money in advertising and marketing. And possibly a side effect of decreasing advertising and marketing is they did see sales decrease. I'm not sure which came first, decrease in sales, so they decreased advertising and marketing, or did they decrease advertising and marketing to get a control on spending, and that led to a decrease in revenue. I think we'll be able to see which one it is maybe in financial year 24. But the company was profitable this financial or last financial year, $8.6 million. And they were loss-making last year. And I'll talk about this more in a second. Not only that, the company's management is really positive about the future. and they gave a really big dividend to their shareholders. And that's another reason I took a position in this company when the share price broke out. Let's have a look at the share price breaking out. So the share price of this company broke out on the 22nd of August 2023, one of the classic breakouts. You can see the share price going sideways since about May 2022. So the share price was going sideways for about a 15-month period. And it was quite obvious. As soon as the share price got above, what was it, 38 cents, that would be a breakout. And it did exactly that. Share price broke above 38 cents on the 22nd of August, and then the share price quickly went from 38 cents to 64 cents. Then we saw a lot of volatility since then, but the share price is still in a really good uptrend, even though the share price has fallen a fair bit over the last few days. So I'm not concerned about the chart. I'm not concerned about the selling in the last few days. I think this is just panic selling. And the reason I say that is we haven't seen a lot of volume. So volume is quite low over the last few days, particularly compared to when the share price broke out. So that means most of the people who have shares in this company aren't concerned at all. Now let's go back to this company's Appendix 4E and the financial year 23 results. And we'll focus on, I have to go find it now. So we'll look at the gross margins. And this is where I was a little bit surprised. Now, in fact, I won't mention capital expenditures yet, but that's nothing that surprised me. So sales revenue this year, 65 million, cost of goods sold, 12.6 million. So gross margin, 52.6 million. Not only this year, but the gross margins last year were really good. So gross margins of 80%, which seem really high for this type of company. And then if you look at expenses, advertising and marketing expense, by far the biggest expense. Last year, they spent $32 million on that. This year, $23.3 million. So even though they were loss-making last year, they were actually profitable this year by $8.6 million. Now, also, this company didn't have to pay listing and capital raise fees of $3.9 million. And the other reason why this company was profitable this year is because of share-based payments expense. $6.5 million last year, only $115,000 this year. So first thing that really drew my attention to this company was the gross margins. And the reason gross margins are attractive is simply because it gives the management a lot more flexibility. Now, if I see gross margins starting to drop, that would be actually a really negative sign that this company doesn't have the pricing power. And the reason I say that is if the cost of goods actually increase and they can't increase the price of selling the underwear, that would be a bad sign that people think the price of these underwears are high enough. And I probably would say right now, the price of Step 1 underwear is quite high. So the quality of their underwear needs to be quite good to maintain these sort of margins. Now, if we move further down in the financial statements, another thing I want to look at is cash. $38.3 million of cash, $23.3 million of inventory, but just focus on that cash. $38.3 million of cash, no debt. In fact, very little liabilities. Total current liabilities, $9 million, no non-current liabilities, which means net assets at $57.1 million, a nice increase from last year, $48.6 million. And the main reason there was that $9 million increase was because of profit. We can see that in the next bit. Issued capital gone down a bit. So there was a reason behind that, which I won't get into in this video, but retained profits up about $8 or $9 million. And that's why total equity has increased. Nice return on equity. So you divide the return by total equity. So you probably get about 15 to 20%, which is exactly what I'm looking for. And now we get to cash flows. Okay. I think I've already hinted that this company is non-capital intensive. They don't spend a lot of money in capital expenditure. That is quite important, in my opinion. That's one of the reasons why this company has really good gross margins. And we can see that in the cash flows from investing activities. Payments for property, plant, and equipment, $77,000 this year, only $19,000 last year. And that tells us that this is a non-capital intensive company. They're not spending a lot of money on capital expenditure. So there is something to like about this company when it comes to simply that. Now, the other things I look for here is operating cash flow, $4.6 million. And because this company doesn't spend much money in investing, capital expenditure, and financing activities, so the only thing they spent in financing activities was the payments for purchase of treasury shares, which is why their Issued capital went down. That's all. That's the only reason why it went down. So not much spending in investing and financing activities. So that operating cash flow went to the bottom line. That's why the cash on hand increased for this company to 38.3 million. So don't look at the market cap for this company. You have to focus on the enterprise value. That gives an indication on the value of this company. And right now, the enterprise value of Step 1 would be below $100 million, maybe even 95, maybe between 90, 95, something like that. And actually, I can tell you right now what it is. If we have amount of capital somewhere here, it will be somewhere in here. But anyway, I would assume, in fact, we can tell by here. Trading good. So market cap 138 million, but the share price has decreased about 10%. So 125 million, $38 million of cash. So enterprise value might be as low as $87 million. And the profit was 8.8. So the PE ratio of this company is less than 10. Well, not the PE ratio. The enterprise value to earnings ratio would be less than 10. When it says the price earnings ratio is 16.2. I believe in these sort of companies, net cash companies, you have to take into account the cash the company has on their books. You can't just exclude it. You have to take into account. Now, another thing I want to look at is disaggregation of revenue, because this company is this is an international company, and you usually find these in the notes. Here we go. So 3 geographical regions, Australia, United Kingdom, and United States of America. Revenue has gone down in all 3, but by far the biggest market is Australia. But United Kingdom is not that far behind, while United States of America is a really small portion. In fact, the revenue in the United States of America actually almost halved, which might be concerned. Well, maybe not concerned, but maybe they've really pulled back on their advertising marketing in the United States of America. Anyway, so this is a potential significant growth company in the world, maybe not in the world, in Australia, if they continue to expand overseas. That remains to be seen right now. So there are a few reasons to like this company at this point in time. Share price has just rebounded. There are a few things to like about this company. Gross margins, non-capital intensive company, doesn't seem that expensive. I suppose a question moving forward is how quickly they can grow, particularly overseas. Have they hit saturation in Australia right now? I doubt that, but I did say to someone recently that I did buy some Step 1 underwear, and they knew exactly what I was talking about. So the name Step 1 clothing is out there. People do know about this company. So that probably does suggest that the advertising and marketing has been successful. Now, the next probably important thing to mention is whether people think there is value in their underwear. Remains to be seen for me whether I do see value. I actually did buy 7 pairs, cost something like just over $100 because 40% off during Black Friday. But that is the next question I have. Do I see value for money? And even if I see value for money, doesn't mean everyone else sees value, or vice versa. If I don't see value for money, doesn't mean everyone else won't. So just because you might have an opinion doesn't mean that opinion is going to be the majority opinion. It could be by far the minority opinion, a vast minority opinion. So you have to look at what the market is telling you. So one negative is revenue down, advertising marketing down. Is that a bad sign moving forward? Good things is, again, as I've mentioned, really good gross margins. And what's the other one? Yeah. Oh, yeah, a non-capital intensive company. So if you have any more questions about this company, any thoughts? Does this company belong in my small cap portfolio? Should I hold this for the longer term? Does this company have potential? Love to hear your thoughts. I'm unclear right now, undecided right now on where this company fits in my portfolio. So leave your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.